stop doing what 90% of traders are doing, right? So if everybody's doing the same thing and everybody is very generic, there will be no edge there. Every single successful trader that I know or I have talked to,
Welcome everyone to the Words of Rizdom Podcast. We are back once again. Well, now we're actually in New York. And for the first time ever, we've gotten off a plane and come into the studio. And it's obviously has to be for a very special guest, which is none other than Carmine from Investor Trades. Thank you for being here, man.
thank you for having me.
I know we're meant to have a little coffee beforehand, but the traffic here in New York's a bit insane.
Yeah, I give you credit, man. 20 hours nonstop flying, no sleep. You didn't even get a coffee at Starbucks before this.
Yeah, I know. It would mess me up, man. That's what I was saying to you. It would mess up the flow. But yeah, no, unfortunately, we missed our first flight, because there was a traffic accident. And then we had to sit in the car for 3 hours. Then when we got there, we had to wait for 4 hours for the next flight. But this is what it takes.
We're here.
This is what it takes. That's it. We're here.
We're here. We're going to make it happen.
That's it. Now, I'm going to go straight into it with you, which is why trading?
I have family on Wall Street,
Mm-hmm.
and I got introduced to trading back in 2016, back in economics class. It wasn't so much trading. It was more of like an economic stock market game, and just the thought of the infinite possibilities that could come with the market and the freedom that it could bring.
Mm-hmm.
I mean, it's a no-brainer to get involved with it, and then it all went from there.
I'm interested, though, because obviously say family on Wall Street. Didn't that put you up? Did they not tell you horror stories of the pain and the suffering?
So it's funny. They told me horror stories,
Mm-hmm.
and everybody that comes to me and wants to learn how to trade friend-wise that I
Mm-hmm.
know personally, I always tell them that it's a big commitment because a lot of people think that it's just going to come easy and they're going to learn something and, get rich quick. And that's not the case at all.
Mm-hmm.
So yeah, there's a lot of horror stories, and I'm sure we're going to get into it on this podcast, the
Mm-hmm.
good, the bad. And it's a crazy business, but the possibilities are endless. And knowing that the possibilities are endless, I mean, I don't know why anybody wouldn't want to work towards that.
From your journey, then maybe obviously observing a lot of traders over your time as well, have you seen that people have that commitment in them?
No, not a lot of people have the commitment, and that's probably why a lot of traders fail, is because they hop on the market one day, the next day they're not on it. There's no commitment. There's no longevity in it. They think they're going to get rich quick.
Mm-hmm.
And the faster you come into this game is the quicker that you're going to leave this game.
Definitely. Did you have that yourself, though? Because obviously you had the positive of family on Wall Street with experience, but did you still have that same mindset yourself?
Absolutely. When I first got into it, I struggled severely just by wanting to get rich quick. I wanted to see my position of $1,000 climb to $10,000. I wanted to be right on this one trade. I wanted to make money fast, and that was one attribute that probably set me back pretty bad.
Mm-hmm.
And you have to learn from it, and I think everybody has to go through that, and everybody will have that mentality because it's just human nature. You want to be correct, you want to make money, you want to get rich quick, and you want to change your life and have the freedom. So I think it's normal for every single trader to have that attribute towards them.
Mm-hmm.
But the ones that make it in trading will get past that because they got through it.
How would you say you got past that, though?
My journey in the first 2 years, what I did was I had multiple accounts of $3,000,
Mm-hmm.
and each account of $3,000 slowly bled. I was buying the market with no trading plan, seeing it go up. I was short the market just because I saw it going up. There was times where I would hold on to losers because I was afraid to be incorrect. There was times where I would let my profit target hit, and I kept holding because I wanted it to run and run and run. So after you go through these mistakes and after you go through these lessons, you eventually learn from them.
Mm-hmm.
And I think why a lot of people struggle is they go through the mistakes and they go through these failures, but they don't reflect upon it or they don't take a lesson out of it. They just consistently go through those failures without any reflection on it. And the brain loves habits. So the more times you do something over and over and don't reflect on it or don't try to build upon that, then your brain is so used to that your brain just wants to keep doing that because it's so comfortable with it.
Yeah.
And that's why a lot of traders make the same mistakes over and over. I'm sure you felt the same way. Like, how many times have you made a mistake and you kept making the same mistake over and over and you knew the mistake you were making, but you kept making it?
Definitely. Well, I did that for like 3.5 years, just the same mistake, same thing over and over. A lot of pain, a lot of money lost for no reason. And what was it for you in terms of that sort of reflection point then, actually reflecting on those mistakes? Because for me, it was a case where I made a big mistake and I really had to sit there and say, okay, either I change now or I quit. Did you ever have anything like that?
Yeah, well, when I saw my accounts continuously deplete, I knew I was doing something wrong. I just didn't know, and I couldn't pinpoint exactly what it is that I was doing wrong. So I knew something had to change, because it's insane if you keep doing the same thing over and over and you keep failing and you don't try to change it. And a lot of people have these mistakes, they make these mistakes, but they think one day they're just going to wake up and automatically they're going to make money, automatically they're going to be a better trader, and it does not work like that. You have to put the work in, and you have to reflect upon your losers.
How long did it take you to start seeing that sort of consistency and that change in your trading?
2.5 to 3 years into my trading, I'm not going to call it that I got lucky in the market, but I took some very big trades back in 2017 when blockchain was a big thing and all these cryptos were really slowly starting to get introduced with the market. There was actually a stock ticker called Longfin, LFIN, and that thing absolutely exploded one day, and that was a very good booster to my account that gave me a lot of cushion of my earlier mistakes. And then I just built upon that, because I knew now I had funds in my account that I didn't have, that I lost. And now I knew that if I kept doing those same mistakes over, when I grew my account, I knew it would just go down in value again if I did make those mistakes continuously over and over.
So you had those mistakes, so you had lost capital. You then had this big play that allowed you to make that capital back and then some.
Right.
So you had that cushion. And then that was the pivotal moment where it was like, okay, look, I'm in this opportunity now where I'm actually up.
Right.
And now I don't want to go backwards.
So I viewed it as I had like a baby, and I wanted to protect my baby at all costs. I messed up in my first couple trading accounts, and I didn't want to give up my baby again. Now that I had some sort of protection or some sort of cushion that I could build upon, that I knew I could grow it, I didn't want to give that up. So I did everything to protect that. And by going with now a defensive mindset and understanding that I have to play defense and learn and reflect upon my earlier failures, that's what kind of grew it. Now, the growth wasn't exponential. It didn't happen in a year. But the consistency comes. And when you have the consistency and you have the momentum, that's when you're going to build. And that's when you get that exponential growth that just continues to climb.
Definitely. No, I love that analogy as well. In terms of like defense, are you referring to more like the risk side?
Absolutely.
Really focusing on the risk?
Yeah, absolutely. So I didn't have any risk parameters at all. And I would say the aha moment, or the biggest influential change to my trading, was understanding how important risk management is. I did not have a risk management plan. There was this one trade, and I did a journey video on my YouTube, and there's the exact chart of everything, where I would see the market climb, and it would exponentially climb. It would gap up. It would rally. There was a ton of volume coming into the market, and I would simply short the market just because I saw it go up. I would short 100 shares, then add to that losing trade, and keep adding and adding until I had no money left in my account. So there was absolutely no risk parameters involved with my trading in my first year and a half, 2 years. And then once I understood that you have to play defense, and risk is the number one most important aspect to your trading, that you have to protect it, because if you protect it, you will grow it. If you preserve your capital, you will grow that capital if you do everything to manage that risk.
Makes complete sense. And now a lot of people struggle with that. I remember that was basically one of the things I did, where I would go into the mindset of like, okay, I need to risk 1 or 2%. Yeah, that's how I'm going to do it long term. And then very quickly, suddenly you're taking trades with no stop loss.
Exactly.
And the risk is just completely open, and then you're just blowing out accounts for fun. And it's not a good position to be in. You know, it's not, as you say, though, it's so interesting how the mindset just kind of repeats the same negative traits over and over.
The brain loves habits. And when you consistently repeat those negative habits, you're never going to get in the habit of breaking those habits, because you're continuously doing them over and over, and your brain is so used to it that it's comfortable with it. So that's why growth comes by doing things that you are uncomfortable with, and you have to start doing things that you are not used to, especially if you're in a place that you don't want to be. You're in that place for a specific reason. Now, for you to get out of that place, you have to do something that you're not used to, and that growth comes from just being uncomfortable and loving being uncomfortable, knowing that the growth comes from the unknown.
Yes. No, I love that. And would you say the process, and it's something that's very interesting, so it's not a case of like going from negative habits to positive habits. It's actually negative habits to changing habits.
Correct.
Right, the habit of changing habits to then obviously positive. Is that a process you went through yourself?
Absolutely. As soon as you start understanding that capital preservation and understanding how risk management is so important, because you have to think about this. As traders, we never know if the market or if our trade is going to work out in our favor. It's not known. We know maybe probabilities are higher before entering that trade, but we'll never know if the trade is actually going to work out or if we are going to make money on it. So with that said, and the only thing that we can control, because we have zero control over the market. We have no control over if it's going to go up, down, sideways. We have zero control over the direction. The only thing that we have control over is our emotions and our risk management, where we could place our stop loss. And you have to obey that by that stop loss. And you're going to go through these negative habits of holding past your stop loss. And I do think that every trader will go through it. And I think it's vital for you to actually go through it to actually change those habits, because you're going to want to, hit yourself in the head and say, okay, I got to do something differently, and I got to protect my capital. I got to manage my risk, because that's the only way I'm going to grow my account.
No, definitely. And I think it's interesting because when you speak to traders, you don't want to put them down. You don't want to put them off by saying, this is what you're going to experience. And you don't want to just try and say like everyone has to go through it. But I feel like everyone does, they always will. It's maybe some slightly different than others, but the majority, everyone goes through the same journey almost.
I think it's vital for every trader to go through failure. I think failure is necessary. Without success, you're not going to even know failure. So I think every trader has to go through some sort of failure, whether technically, emotionally, psychology, it doesn't matter what type of failure it is, but I think you have to go through it to get through it. And traders that don't go through the failure, that just get placed at success, will have failure right around the corner, because if you got placed at success, the only way to go is down. If you start by failing, the only way to go is up, especially if you learn from those failures. So having a success right off the bat, making a quick amount of money in a short amount of time without failing is probably the worst thing that a trader could do, because essentially you're getting placed at like the top of a mountain. And once you're at the top of the mountain, you can't keep climbing. And the only way to go is down, especially if you don't develop the positive habits that bring traders to success.
In terms of where you were before then, before finding that consistency, what did risk look like to you?
I had zero risk parameters. I would simply enter a trade and I would feel butterflies in my stomach. And again, I think every trader probably listening to this, watching this, is going through it or went through it, where you would enter a trade, you would feel butterflies in your stomach, you'd start sweating, you'd start feeling adrenaline pumping through your body, you'd want the position to work out, you want to be correct, you want to prove to your friends and family you can make money, you want to prove to yourself especially, and then as soon as you get in that trade, it starts working against you, and you're like, I don't want to be wrong, and you hold past your stop loss, you take a big loss, and it detrimentally hurts your account, and it also affects your mentality, and you're done after that. If your mentality is shot, it's very hard to keep climbing.
And what does it look like now then? So the transition.
Every single trade that I take has a planned and managed risk parameter, and my risk management, my risk parameters always invalidates my trading thesis. Where I'm at currently in my trading, I'm not so fond of believing in like risking 5% of your account, 1% of your account. For others, I know they go through those systems, and that's totally fine. There's nothing against it. But for me, I just want to make sure at least my risk, I'm only going to lose 2 times less than my winners. So I need to make sure my winners are at least 2 times greater than my losses before I enter a trade, at least where I'm at in my trading right now. That way I can put myself in the position that if I have, let's just say, a 60% win rate, my risk management rules are putting me in a position to be profitable, because you have to position yourself to be wrong as much as possible, yet still can make money.
Yeah, no, I love that. And I think that's the best way to be, because as you say, there's unpredictability with the markets. You can't predict what the market's going to do. You can try and have an edge, of course, to then put things into your favor, but that's all you're doing is putting it in your favor. But the thing you have control over is your risk. So if you're planning for a strike rate where you actually lose more often, for example, but the risk to reward and your risk parameters are keeping you profitable anyway, then you're putting yourself into a position of success.
And you have to love to lose. As weird as and silly as that sounds, you have to love to lose. Like the best winners will lose. So you have to understand that losing is part of the game, and the best losers can control that risk. I'm not going to say I love losing, but taking losses not only gives me a lesson that I can learn off of, and I don't mind losing because I can manage that risk, that I know if I hit my next setup or my next 2 setups, I know that win is going to take care of that loss because I'm putting myself in the position to win. And a lot of traders don't do that.
Would you say there's a process that you had to go through to learn how to lose? It's time to make the biggest announcement we've ever made on the podcast. You guys have been asking for it, and we've finally done it. We are launching the Words of Rizdom Patreon. As part of the Patreon, you are going to get every single week exclusive podcast episodes. Every single month, I will be hosting live calls where you can ask your questions to me directly. We will also be doing Q&As with industry-leading traders such as Umar Ashraf, Omar Agag, Lifer Paladin, Jade CapFX, and so many more. I'll also be doing huge giveaways every single week for Patreon members only. And finally, I have partnered with the top companies in the industry, such as Social Trader Tools, Magic Keys, and TradeZella, to bring you the biggest discounts, saving you hundreds of dollars per month. Now, I know that sounds like a lot, and I know what you're thinking, but it's just $15 a month. It's just 50 cents a day. And with that, you're going to get exclusive episodes, live calls, Q&As, giveaways, and the discounts that I have secured for you. With the discounts I've secured, I'm basically paying you to join. Learn from the best.
Absolutely. Everybody that takes a loss knows how bad it feels. There's nothing like sitting in front of your screens for 6.5 hours a day, let's just say, taking a loss and then having to go deal with other aspects of life after you just lost in the market. You feel like a loser. You feel like you don't know what you're doing. You feel like that trading's not for you. You want to just give up. So by going through that, you kind of get accustomed to the losses and you realize what you have to do in order to propel you forward.
We haven't talked too much about strategy. So what sort of strategy are you implementing into the markets as well?
Right. So I'm a short-term trader and day trader. I like trading and buying and selling within the same day. I don't like putting risk on overnight. I would say it's very important to understand the personality of a trader to fit the type of style that you're looking to approach. A trader that is not very creative or a trader that cannot process information very fast probably will not be successful as a day trader or a short-term trader. But a trader that can, sit at their desk all day long, maybe not have to actively monitor their position, maybe has a little bit of a timid or shy personality, probably would be better at more as an investor or longer time frame participant trader. So for me, I like getting in and out in the same day, and I would say I'm pretty creative and I'm a very good problem solver. And for a short-term trader, I think that's a necessary skill to acquire, because the market on a day time frame is going to throw different things at you. It's essentially going to throw a rock at you. And if you're sitting in the chair, taking the rocks right to your head, and you're not sitting there trying to deflect them and try to avoid them, you're just going to get ran over by the market. You're going to get hit and your account's going to hurt. So you have to be a very good problem solver, critical thinker, being very creative and adapting to certain market conditions to fit how you trade. And for me, I'm a short-term trader.
Definitely. No, it makes complete sense as well. And I love what you mentioned there in terms of understanding your personality as well, because I think a lot of people overlook that. I think a lot of people nowadays, especially with the rise of social media and the amount of traders who are on social media, people just look and they say, oh, copy paste.
Exactly.
And I feel then they go copy paste, but then it's not actually pasting. It's not working. I'm not getting the same results. Yeah. But it comes down to, as you said, they haven't reflected on their personality as a trader. So I love what you said there. In terms of, are you a technical based trader, a fundamental based trader?
Technical, no fundamentals. Technical, short term, order flow, price and volume, price action. That's basically how I trade, just using, I view the market as an auction. So for me as a short-term trader, and this could even apply to long-term traders, is the stock market and looking at a physical candlestick chart simply projects the price of where it's currently trading at and where it traded at in the past. So simply the market as an auction, you have to view a candlestick chart as an auction, and the market simply moves up because of more aggressive participants entering the market. And the market moves down because there are more aggressive sellers entering the market. So you have to start viewing it as an auction. And when you view it as an auction and understand that charts form because of buying and selling, that's where a serious edge could come in. I don't believe much in patterns because patterns themselves do not move the market, but the type of buying and selling around those patterns will move the market. So I think it's very important to, if you're a short-term trader, to gauge how the market reacts to certain levels of interest that you create. A lot of people will create a level or create a trend line or create a specific support level or resistance level and say, okay, as soon as it comes up to that support level, I'm going to buy the market. Or as soon as it breaks it, I'm going to short the market. But for me personally, where I develop the edge and where I find the most success with is creating levels of interest and then gauging how the market reacts at that level of interest via the order flow. For example, if we come into a support level, and again, viewing it as an auction, we come into a support level and there's tons of buying there, absorbing all the aggressive selling, it's a good indication that the market may want to reverse, a lot higher. So once I switched to the market as not so much as a candlestick chart, but as an auction, that's when a lot of things changed.
Definitely. And there's a couple of points I want to pick up on there. In terms of the absorption, what does that mean? What are you referring to when you're saying like, okay, the sellers are being absorbed by the buyers or vice versa?
So imagine there being a ceiling or imagine there being a floor, and how support and resistance actually forms, like the true backbones of support and resistance, is if there is a more passive participants at that level than aggressive participants. So again, the edge comes, and why support and resistance actually forms is through a lack of activity. Meaning if there's more passive sellers at that level than aggressive participants, the market will cause that ceiling and the market will cause that floor. So gauging how the market not only forms that level, but also reacts to that level once it's tested is where the big edge, in my opinion, for short-term trading comes in.
I love that. I love that. And it makes sense to me. So I'm hoping it makes sense to everyone out there as well.
So absorption forms when there is aggressive participants actively hitting the offer or hitting the bid, but despite all their effort of hitting the market aggressively, someone is there passively on the opposing side of the market, essentially absorbing all their orders, causing that ceiling or causing that floor. Essentially, if you have a bunch of buying near a resistance level and there's zero upside follow through at your resistance level, it's a good indication the market may want to test lower prices because some seller is passively absorbing all those buyers. A lot of traders say there's more buyers than sellers at a level, or there's more sellers than buyers. But in the market, an auction, there could be no such thing as more buyers or sellers in the market. Every single transaction comes from a buyer and seller. Now, there could be more aggressive participants than passive participants because that's how the market moves up and down. But there's no such thing as more buyers than sellers.
In regards to like the patterns you mentioned, right? I find it very interesting because the way I view the patterns, or whether it's even fundamentals, people try and talk about how is it that the technicals and the fundamentals, even if it's something random like the geopolitical stuff that we're seeing at the moment, but yet it lined up on the charts. People started going, oh, well, how does that work? But for me, everything's a representation of what you're saying in terms of the auction, like buyers and sellers.
Right.
So even like the patterns, for me, the way I see it is that the patterns are just describing, or is a picturesque, if you will, version of the emotions of the buyers and sellers.
Exactly.
Right? Would you say that's the same?
Absolutely. Yeah, absolutely. And so the way I view the market, again, is essentially, let's say you're in the market for a new car or a new house, and the average price of a car or a house, let's just call it $100,000. That's the average price of what people are buying a house at. Wouldn't you want to buy a house at $75,000 that maybe one house comes on the market? You see, oh, it's a good deal at $75,000. Let me try to buy it. But as soon as the price goes down, a lot of people are trying to get into the market at the same time. The edge and where majority of reversals come from is when there is a lack of activity at a certain level, causing the market to go test opposing prices. The market essentially is an advertising mechanism, and it facilitates its trade. So reading the charts, like you said, and understanding how it evolves around human psychology and human emotions, being able to read that and being able to read the emotions of traders, again, it will be where the edge is. And you have to think about something too. If 95% of traders fail, stop doing what 90% of traders are doing, right? So if everybody's doing the same thing and everybody is very generic, there will be no edge there. Every single successful trader that I know or I have talked to has a unique aspect to their trading strategy. Being generic in the market will get you nowhere. And a lot of people try to press these strategies that will win 100% of the time. But if you come to somebody with a strategy that is unique, that is different, that I haven't heard of before, I know you're legit, and I know that you know what you're doing behind the markets and you're actually making money.
And definitely, I love what you said there in terms of like majority of people losing, but then the majority of people have the same habits, And I feel like it kind of goes back to what we were saying earlier about people just being stuck in the same habits. And I think a lot of people observe the same fact that most people are doing this or most people are doing that, but they'll still fall into that. It's kind of like the herd mentality. You know? People just follow what everyone else is doing, and then they struggle with change. They struggle to accept change or being uncomfortable, as you mentioned earlier. But it's necessary, I would say. And in terms of like sort of following through with that topic, drawdown. This is one of the most uncomfortable things that a trader will handle, especially if they've overcome handling losses and being able to control their risk. Next up is handling drawdown.
Yeah.
How's that been for yourself, especially as you've scaled, I guess, account size as well and capital that you're trading with also?
Yeah, so 2 weeks ago, from the time of recording this podcast, I went through a drawdown. There was just every day I was taking my setups. They were my normal setups that I take, that I make money on, and they just simply were not working out. And it definitely affects you mentally, and it definitely questions, I've been doing this for 8 years now. So even after these 8 years, it still questions your ability. You're like, I'm doing everything that I was doing last month, but for some reason, right now, these past 2 weeks, they're not working. And it definitely will get to your head. And we're all humans. We cannot avoid emotions. We can't escape them. We have to go through them, right? But as you become more accustomed to them and more accustomed to the market and your strategy and your psychology and your emotions, you know how, you know when different conditions bring them upon you, and you know how to get over them, and you know different things you have to do to not think about them so much. And that's where having something else other than the market is a very important aspect to your overall well-being in life in general, because if your sole passion is the market and your sole focus is the market and you have nothing outside of the market, your drawdowns in the market are going to affect you outside of the market. Your P&L swings going up and down, if you make money, you're going to feel like you're on top of the world. If you lose money, you're going to feel like you're the worst trader and you should quit. So having something outside of the market for me personally is something that I'm currently trying to work on, that when I do have drawdowns, because they are normal, it gives you that escape that you're not so focused on your P&L and how it affects your mood up or down. And I would say majority of drawdowns occur not because of your strategy, but because of the market conditions. Yeah. Now, a lot of traders have to realize this. And I would say this was probably another pivotal moment of mine. I would say probably year 3 into my trading was how important adaptability is. You can use the same system over and over, and a lot of traders teach one single system that it's a one size fits all that will work when the market's uptrending, when it's on low volatile conditions, when the volatility is high, and they preach this system with no influence to adapting to different market conditions. Yeah. You have to trade differently. Like, I trade differently when there's volatility. And when there's no volatility, I trade differently than I would if the market's, let's just say, trending. So you have to have an aspect of adaptability. And if you go through a drawdown, you have to figure out, is it because of your emotions or is it because of your strategy? Now, sometimes the strategy needs to be tweaked to make it fit those different market conditions. And the only way you're going to learn that is actually trading in those market conditions. It's not something that you can learn like in a book or watch a video. You actually have to sit through those market conditions and be susceptible to the change and adapt to them. It's not going to get placed in your lap, and you have to actually physically feel it and understand it for you to adapt it to your trading.
Now, market conditions are so important. And what's interesting about your journey is that you've traded, no doubt, through many different conditions, one of which being the COVID sort of market time. It's very volatile across pretty much all the markets. What was your experience obviously trading through that and then even transitioning to obviously now?
So that's a very good point, because even for myself, the whole COVID market was a new experience for me. I started trading in 2016. So I never had a market drop and so much fear in the market like we had with COVID. Yeah. So that was all new to me. And I'm still learning new things every single day about myself, even about the market. And having that open-mindedness to learn new things with new conditions will give you the tools needed for long-term success. So back in the COVID market, I learned what a lot of volatility meant. I learned what a lot of fear was. And I learned, I'm not going to call it easy, but how clear the market conditions were and how fast the market moved and how fast your P&L swing could fluctuate on a daily basis. A lot of traders made a lot of money back in COVID. And I can guarantee you 95% of them are not here to trade today, because they most likely lost all of their money because they got rich quick. It was an easy market. And as soon as the market started to recover, they had no idea how to trade.
What allowed you to not be part of that 95%?
So when we bounced with COVID, I did have a hard time trading that. It was new to me. It was a random bounce. We thought that the market was going to continue to go down. We thought we were in a recession. We thought that the world was ending. So that bounce definitely caught me off guard. It was new to me. I had to learn how to trade those conditions. And that was, a very strong bull market. And after a few weeks, you start to get used to it and you start to adapt to how those conditions trade and how you are going to succeed in those conditions. Because if you approach the market back in COVID when it was just dropping every single day and it was quote unquote easy, when we rallied, you probably had no clue how to trade that market if you were going in there with the same mentality. And adaptability is key.
Yeah, I feel like a lot of people obviously struggle with accepting the changing conditions, accepting their bias might have been wrong or their thought process might have been wrong. Like in that scenario, it could have been very easy. It's easy for you to say now, or for you in your position to be able to say, okay, I adapted after a few weeks and I changed, etc. And I learned from it. But most people won't find themselves in that position.
Right.
Most people will find themselves attached to their idea and unfortunately be doomed to repeat that process over and over, or as you said, majority of people ended up losing the capital that they may have made. What was it? Was there anything in particular that really shouts out to you that allowed you to be a bit more insightful, allowed you to be a bit more adaptable, a bit more fluid with the market rather than being sort of just fixed in your mindset?
Well, there's no growth when there's stagnant waters. A fish can't live in water if it's stagnant, if there's no movement to it. So for you to change or for you to grow, you have to move. Motion creates emotion, and motion helps remove emotion in the markets. So the biggest thing, again, is reflecting on the market conditions, reflecting on how you trade in those conditions, and most importantly, reflecting on your emotions in those conditions, because different conditions bring different emotional responses to different moves in the market. Back when COVID happened and there were insane price drops, everybody's emotions were through the roofs and they were over leveraging into positions and actually making money. Then once the volatility died down, they were still entering the market with over leveraged size, not realizing the volatility is dying down, not realizing we're bouncing, we're uptrending. And a lot of those guys lost money pretty fast. They made.
It's interesting you say that, actually, because they've picked up the habit then of essentially being rewarded for making bad moves. So therefore, once that reward is ended, they're still making the same bad moves, which then causes, unfortunately, the end of their trading career, or at least for that trading period. How often have you noticed actually that, in terms of conditions, let's say you take a losing streak, like you mentioned 2 weeks ago, you had that bit of drawdown. In the past, have you found that when you may have had that drawdown, you'd actually then say, okay, I'm going to take a break, and then I'm going to come back in, it could be a month, could be 2 months, whatever it may be. And then people find themselves in that cycle, where they're not actually putting in the time to feel uncomfortable and to learn and to go through that cycle of those market conditions. Instead, they kind of skip it. Right. And then they come back and they might be in favorable conditions to what they're used to. They get a nice, good period. Once the drawdown starts again, they do the same thing. They just take a step away and they just repeat that same cycle, versus having to actually sit through and experience those different market conditions, how those changes are made, and what the P&L looks like, what the edge looks like, what the specific little changes may be, to actually be profitable during those different conditions.
Yeah, and again, relating back to the aspect of getting placed at the top of the mountain or having success handed to you. A lot of traders back in those times, where let's just call it easy market conditions, got placed at success and it was just handed to them. So they had no idea how to actually earn that success. A big part of that is the adaptability, like you said, about taking breaks after a drawdown, taking a month off. I personally do not believe in that, because the only way that you can learn is by immersing yourself in the market conditions. Now, maybe not take a break from the screens, not turn your computer on for a month or two. I don't believe in that. But maybe take a break from actually putting your live money at risk in the market, because the only way you're going to adapt is by being in the middle of the battlefield. And the only way you're going to be able to deflect the rocks the market throws at you is by actually moving. So being able to sit in those different market conditions, even if your real hard-earned money is not at risk, will still offer valuable lessons that once you build that confidence that say, okay, I have to change how I trade here. The market conditions may be ranging now. We may be uptrending. Let me figure out how the market will respond to the core aspect to my trading strategy. So I believe that having one strategy in the market is not the right approach. If we have the core strategy, we can branch upon those cores. So if the core foundation of a house could be built upon, we can add many different things. But the core of the core foundation of a house will always be the same.
Yeah.
But we can build upon that house to different rooms, different avenues, and make it different. So the core for me, what I have the most success with is simply just price and volume and viewing the market as an auction. And you can branch to different strategies off of that to fit different market conditions.
Even then, like the branches that are then built on that, or the variants, if you will, are just very slight. So it's not a case where it's like, you know, there's a whole different strategy on this side for this conditions and a whole different strategy on this side. Like one's day trading, one's swing trading, or one's price and volume, and another one's break and retest to buy, you know, completely two separate things. Instead, it could be just like the risk to reward might be different for this condition versus this one, or the way that I manage risk is slightly different, or maybe a certain type of confluence is used for that condition because it's a pattern that I've recognized. Is that, in terms of pattern recognition, is that something that's been very important to make these decisions?
Absolutely, absolutely. So again, like the core foundation of a house will always be the same. And in your trading strategy, the core foundation of your strategy will be the same. But in low volatile conditions, having a tighter stop loss will not make any sense. Versus volatile conditions, lowering your position size, widening your stop loss will give that trade room to breathe. And the adaptability aspect of this is traders will look for that one size fits all strategy where their risk parameters are the same, not putting any influence on the market conditions, that their stop loss on volatile conditions might be 2 points. And then low volatile conditions might be 2 points, and it's the same, not putting any emphasis on the conditions. And your entry signals, your confluence, your risk parameters, and how you trade have to be different depending on each market condition. And the only way you're going to learn about specific market conditions is by having screen time and experience. You cannot learn the certain aspect of trading that comes with intuition and then comes with feel. A lot of traders say you shouldn't trade on intuition, you shouldn't trade on feel, but there's an aspect of trading that can only be developed through your screen time and experience. You can read all the books you want, you can watch all the videos that you want, but the best educator will be your screen time and be your experience. That will be the greatest lessons that you'll ever learn.
Definitely. And do you feel like most people skip that?
Absolutely. They want to get placed at the top of the mountain. They want success handed to them, and they're going to have it come next to them. When the next trade they take in the market is probably not going to be a good one. Or if they take one good trade and they feel euphoric, the next trade they take is not going to be good, you know?
They'll always be tested.
Exactly. You'll always be tested, and you have to get tested, and your success is a component of how you handle those failures.
I want to talk about in terms of like scaling, you know, like scaling through your journey, obviously managing more and more capital.
Right.
In terms of your positioning, obviously I'm from like more the FX world, and in the FX world, we have like a huge separation between majority of people in the industry right now are using, they were referred to as prop firms. They're essentially evaluation companies. So essentially funding companies, right? So a lot of people getting funded accounts versus their personal accounts or investor capital, whatever it may be. What's the position on your side, obviously, in your trade?
So I've never traded in a evaluation prop firm account. To be honest with you, I can't really speak on it because I'm not educated enough in it. I really don't want to speak on something that I'm not educated on.
Of course.
So yeah, I trade my own capital, and a lot of people go the prop firm route because their own capital is not at risk. I'm not too sure about that because I feel like you have to risk your own capital to really feel the emotional aspect to it. And I feel like if I was on a prop firm eval account, I'm not going to have that emotional connection. And I think a really good lesson in the market is having an emotional attachment to the money.
Yep.
And realizing what it will do to your emotions and how it affects your decisions. When you're connected to the funds in your account, and you know how hard you worked for the money that's in your trading account, and you know how much money is at risk, you're going to trade differently versus money that is paper or on an eval from a prop firm.
In terms of your the scaling, then how have you handled that? Because as you said, when you're putting in your own capital, you know, you work hard for that capital, you're putting that in, maybe you're even compounding the capital. How have you handled, obviously, the amount scaling over time and managing the new risk, the new take profits, the new stop loss, you know, in terms of the monetary size? How have you handled that?
That's a good question. So everybody's going to be different. And I do want to say that in the market, there's no correct approach to approaching the market. There's no correct strategy. I can really only speak for what I do and what I have success with and what works for me. So where I'm at in my trading right now is I'm at a consistent threshold of profits. And the biggest thing that I'm working on is getting past that threshold and scaling my profits even further where I'm at right now. The problem is as soon as I scale up, I trade a little differently because I know I have more money at risk now. So that's that emotional barrier that you have to get through. Now, in terms of scaling up, let's just say you start with a small account of $500. I'm not too sure in the Forex world, what do they call contracts or like position sizing?
We have like lot sizes.
Lot sizes.
Yeah.
So let's call it lot size because in the futures market, it's the same thing. So what I recommend everybody doing, and I'm not too sure how the monetary aspect of a lot size is depending on the instrument, but what I recommend doing is for beginners to start with small size, 1 to 3 lots, no matter what your account size is. $1 million in your account, $100,000 in your account, $1,000 in your account. Start small. You have to prove your concept works. Once you have the proven concept, then you can scale it up. So what I recommend everybody doing, especially those in the investor trade community, and this is the approach I would tell myself going back to 8 years, is start small. Don't let your ego do the trading. I don't care if you have $20,000 saved up that you just got gifted to you. Don't trade with that $20,000. Start with 1 to 3 contracts. Be consistent. Prove your concept works. Prove you can manage your emotions. Prove you can manage your risk. And prove you have a strategy that you can consistently repeat. Repeatability is so key. You have to be able to repeat 1 to 3 contracts for at least a minimum of 3 months. Once you're consistent with that, and I don't really care how much you grow your account, all I care is if you're consistent. Let's just call it $100 profits. As long as you're consistent $100 profits, and when you have your red days, which are going to be normal, they're at least a maximum of $50, so 50 or less, meaning you're risking 2 to 1. Once you could do that for at least 3 months, then I think it's the right approach to scale up. Now you're at 1 to 3 contracts, lot size. Maybe go 5 to 10. And then see if your emotions change from 5 to 10. If they don't change, and now you're making a consistent $500 a day, and your losses are $200, $250. Now you prove you can manage your risk, you can control your emotions, now scale up even further. In trading, it's not working harder, it's simply working smarter. And the only way we can work smart is prove our concept works. And a lot of traders don't have a proven concept, and they go in with their full account size, full port it, and lose it all. And then it messes them up mentally. And once you're messed up mentally, it's very hard to correct those negative issues.
Definitely. Like, so to undo negative habits is much harder than just to focus really and put the time and effort into building the positive ones.
Correct. Yes.
Definitely.
Getting yourself out of the hole is a very difficult thing to do. There's ways around it. There's a good tool that I use. It's like an error cost calculator. So essentially what you do is that if you made a mistake, let's just say it was an emotional mistake, you had FOMO, or you held past your stop loss, or you held onto the trade too long, have an Excel file or a sheet that calculates how much money you lost or calculates an opportunity cost that you missed. And if you review that every week or review that every month, you're going to sit there and review that. And if you reflect upon it and you really take it to the heart, you're going to see how much money that you missed out on or you lost because of your stupid mistakes or your errors. And that's like a good way to get yourself out of the hole, because you're going to wake up and say, okay, if I don't change, my trading account is not going to go up.
A lot of people don't do the work to see that reality, whether they have a tool or whether they need to do the calculations themselves.
Yeah.
I think they don't end up realizing the reality of what their original plan or their original edge they may have set out actually provides. And so therefore they trick themselves into thinking that, oh, it doesn't work. When in reality, maybe the first 1 or maybe 2 trades were with that edge, with the plan, and then the next 3 or 4 weren't. And in that 3 or 4 that weren't, there was 1 or 2 that did fit the plan that you didn't take. And, it's so easy for the numbers to be lost.
Right.
And the true reflection of the edge that you truly set out for in the beginning. Because usually what I've seen in terms of a pattern is, let's say a weekend takes place. On the weekend, they did a forecast. They reviewed the previous week. They planned their week ahead. Monday comes, and they took the first trade with the plan, with the direction they've set out. And then maybe by late Monday, maybe going into Tuesday, they've taken some other idea because something happened in the market. And then by the end of the week, if they actually reflected, which most people don't, but if they did, they would realize their original plan actually took place. But because they allowed their emotions to get the better of them and just being a bit too much in the moment, which is interesting because there's probably benefits to being in the moment as well. But just being too much in the moment, they kind of just forgot the bigger picture, forgot the work and the vision they had. And then they find themselves just like questioning, oh, that edge doesn't work. Let me try a new one.
I see a lot of traders, they take one trade and it works out. They take another trade, it doesn't work out. Then they start questioning their strategy or start questioning their edge. And the word edge is a little complicated because edge is really making the market static. And the market is not static, meaning, like I said, it's constantly changing. So by you referring to you have one single edge, that could be true, but edges are different depending on the market conditions. So by you saying you have an edge really says that the markets are static. The markets are not static. The markets are constantly changing and the markets are constantly evolving. And the best traders and the ones who don't get left behind with the market are the ones that could adapt with it. And like you said, you plan over the weekend how you're going to trade the following week. Monday comes, you take that good setup. Tuesday, you deviate away from your plan for some odd reason, right? Then Wednesday comes, you go back to your original plan. And it's just a big cycle of back and forth. Does this edge work? Is my strategy valid or not? They take one losing trade and they kind of invalidate their trading plan or invalidate how they are looking to strategize with the market. And the way I look at it is you can't go off of one trade. Like if I take one losing trade on Monday, I'm not changing how I trade on Tuesday. If I take a losing trade on Monday and Tuesday, on Wednesday, I'm not changing how I trade. I'm doing the same thing over and over because I know it's what works out for me. Now there's going to be a day or there's going to be a week, and I call it like the middle week or the week that you really have to do the most amount of work of when the conditions change. And you're going to start to know when that happens, when what you're doing that previously worked out for you still will work out, but you have to tweak it a little bit to fit those conditions. There's a week or a couple days that you're going to start to notice that. And that's, again, where those drawdowns come from. 2 weeks ago when I took that drawdown, I had to tweak a little simple thing with my trading. And that simple tweak made a complete difference. And the past week, traded completely different, and it was a very successful week just by tweaking a minor thing to my strategy.
What's interesting because I very briefly looked over obviously some of the content you put out, I think observing your stories as well, and the thing I loved to see, which was the way that you will post about your trades. I don't know if it's in a community or just in your general it's something that you have
a private Discord community.
So like you will post your trade ideas, but the trade idea won't just be like I'm buying at this level, I'm selling here, or here's my stop loss here. No, it'll be, this is what I'm looking for, okay, and this is why I'm looking for it. If price does this, then I'm going to look for this. Exactly. And it's kind of like a flow chart.
If-then statements. I think it's very important to come up with if-then statements. And a couple of things that I do want to branch off into here is that a lot of traders follow alerts or signals. And by me saying this open in the trading community is not favorable to a lot of people. But the reality of it is trading alerts and trading signals will push you back in your trading, and it's not giving you that push forward to have success in the markets. If you need somebody to click that buy and sell button for you, you're never going to be successful, and you're never going to be able to do this for the long run. So the worst thing that any beginner trader or any struggling trader could do is follow somebody's buy or sell alert. The reason why somebody's posting that buy or sell alert, number one, is probably to pump up that instrument. Or number two, they need to look like they are correct to fund their sub money.
Well, I think it's a fair statement to make because a lot of people get into trading to say that they want to be professional, but that's not the professional way to go about it. And at the end of the day, we all know that to be a professional trader, to be a successful trader, you have to think for yourself. You need to, as they say, a man on an island. In terms of
the best analysis will always be your own analysis. Exactly. And I live by that statement because I followed a lot of people in my first 2 years, and I was simply buying and selling. I fell victim to that. I was following alerts and following signals. And again, my account was depleting. And you're never going to be successful by following somebody is buying or selling at a specific level. They probably need you to buy or sell so the stock price could go up so they can make money on it. And they probably can't make money if it wasn't for them pumping up whatever instrument they're looking to trade. And I trade a liquid name, and I'm sure a lot of people trade, like Forex is pretty liquid, so there's no pumping up Forex that much. But I don't believe in alerts and I don't believe in signals, and that's how I've really structured, especially my community, and I respect any other community that does that, is give valid logic behind why you're talking about something. Yeah. Right? If 95% of traders fail, don't do what the 95% of traders do. And what do 95% of traders do? It's very obvious, and you could just open up a simple candlestick chart trading book, or you can go flip open YouTube and see what 95% of traders do. And again, the uniqueness will speak volumes for itself, and the uniqueness in a strategy or the uniqueness in a community will speak volumes in itself. And if somebody's generic or doing the same thing that everybody else is doing, there's not going to be any growth to that, or there's not going to be any valuable lessons. Think about this. Think about you have a pizza shop and somebody down the street opens up another pizza shop. You got two pizza shops right next to each other. One is very successful and one is not very successful. If the one guy that has success in his pizza shop, he's probably doing something unique or generic, not generic, you know, he's probably offering a good product. You have a guy that just opened up a pizza shop down the street. His pizza is probably generic to every other pizza shop that you have in town. And this is with any successful business. This is with any successful product. This is with even trading in itself. Uniqueness will get you far, and being able to adapt and be creative enough that you can switch to the different conditions and switch to the demands of the market will get you far.
No, I couldn't agree more. And in terms of the consistency as well, like just being consistent, you know, sticking through the process rather than just, you know, stopping at the first hurdle or putting in the first 30 days and slowing down, or 60 days and then slowing down. Right. And that's the usual habit. Like we're, as of us recording this, we're approaching New Year's, and that's what's going to happen. You know, people are, one, they're not putting in work now because they're saying, okay, let me wait till January 1st. And when the January 1st comes along, they'll put in 30 days or 60-day sprint, and they'll just fall off for the rest of the year. So consistency on top of everything you listed there is very important. And it's exactly what you said there in terms of that uniqueness, you know. And I think going back to obviously what the community aspect, you know, breaking down your trades in such a way and then being able to actually follow through with the explanation of what you're looking for, why you're looking for it, if this then happens, what you're then looking for next, to then be able to actually execute a trade. Right. And then same with the execution though, of it doesn't stop there, it continues. And it's very rare to see that, I would say, on my side anyway. I haven't seen that too often, where someone's actually breaking down a trade, as you say, with the logic. You know, what is your thought process with that? Is it something that maybe was missing from your journey, and therefore you want to provide that missing gap?
Let's take a break for a minute there, guys, because I want to tell you about the best trading tool on the market, TradeZella. The reason why TradeZella is the #1 trading tool that every trader needs is because you can do backtesting, automated journaling, trade replay, in-depth analytics, and so much more. And the greatest part about TradeZella is that it's all automated. All you have to do is connect your MT4 and MT5. It will pull all your data onto the dashboard. You can add playbooks. You can just add notes. You can add images from your trades, and you can get the insights that is necessary for you to progress as a trader. Now, TradeZella is for absolutely everyone. Whether you're a crypto trader, whether you're a Forex trader, whether you trade prop firms, it is for absolutely everyone. And that is why thousands of traders have signed up using my link here through the podcast. Make sure you use the code RIZ10 for 10% off your monthly subscription, or WOR for 20% off your yearly subscription. The link is in the description below. And let's get back to the episode.
Absolutely. So like I said, like following alerts or following signals, there's no lesson to it. Hey, buy here, or hey, sell here. Why? Why are you buying there, or why are you selling here? So having a thought process is how you were going to learn. I essentially am just myself. I keep it real. I keep it to how I trade. There's no like phony aspect to it, because how I trade is how I come across everybody that watches, looks at my plans, watches my videos. It's how I trade. And essentially it's my own personal journal. So there's how I trade is what exactly you see. And the plans and having the thought process is something that I did not have. I think you're going to learn a valuable lesson, even if you don't take the trade and you had no real skin in the game for it. I think there's going to be a valuable lesson of you understanding why I said this and why I was watching that, because you can reverse engineer it. If you were to study every successful person or every successful trader, you can reverse engineer how they trade. And no one's going to explicitly tell you how they trade, right? No one's going to say, hey, buy here, or hey, sell here. But you can reverse engineer their thought process, and you can reverse engineer their system, their strategy, their levels. And that is how you're going to be able to develop and conform it to your own edge. There's no copy and paste. With alerts, there's copy and paste. With providing my thoughts and levels, there's no copy and paste to that. It's essentially developing what's going on in my head so you can develop and create it uniquely and creatively to your own strategy or your own system. Yeah. And the beautiful thing of the market is the limitless amount of opportunities and the limitless amount of outcomes the market can provide. And again, going back to that unique example, you have to be unique to stand out, right? And in the market, a unique strategy will make money. And when I talk about being unique, it's not like doing something completely opposite of everybody. That's not the approach that I want to come off at. It's just doing things that traders don't do. And that actually makes me think about this. Somebody recently asked me, like, how do you know if buyers and sellers are in control? I'm sure like a lot of people may have asked you, like, how do you know if buyers or sellers are in control?
Yeah.
And I think that's the wrong approach to the market. I think learning who is going to be in the most pain in the market will be where a very valid edge comes into play. Understanding if buyers or sellers are in control is valid and is true, but I think a very powerful edge is understanding where a lot of traders are going to be screwed, because where there is pain, there is gain. If everybody is buying a specific level, the chances of that level working and the chances of the market coming and going in your favor will be very slim if everybody is buying or selling at that specific level. 95% of traders fail. If 95% of people are buying there, the odds of it working is going to be slim, right?
Definitely.
So you have to put yourself in the position of the opposing side of the market. And for me, my edge comes where there is pain, where there is trap traders, where there's that absorption.
Yeah.
And understanding the pain aspect, it's a zero-sum game. So, you know, it's kind of messed up to say, like, I'm looking for other people's pain. But in the market, that's where the most amount of gain will come from.
Definitely. No. Well, it's like they say, you know, what is the word? Be greedy when others are fearful, and fearful when others are greedy, right? Yeah. So it's essentially the principle that everyone kind of learns near the beginning of their journey, and it's the truth though. And you know, what's interesting though is it kind of going back to the order flow side of our conversation. In terms of the order flow, then, do you use it in line with the technicals?
Absolutely.
Or other way around? Do you have the technicals then the order flow?
My order flow confirms my technicals.
Okay.
Yes. If I were to be trading without order flow, I feel like I'm trading blind, and I just can't do it, especially the way I trade. And the order flow validates my level. My level tells me where, and my order flow tells me why. And I need where and why to put a trade on. That's my equation. And without order flow, I'm simply entering the market blindly because I can't gauge what's going on behind the scenes. Again, the candles simply represent where price currently is trading at and where price was trading at before.
Yes.
You need to know what's going on behind those candles. Could it be a lack of passive participants that's simply driving the market higher? Is the rally getting done on a lack of offers? And the chances of that happening, if there's a lack of offers in the market, that might mean that rally has a high odd of it failing. So again, looking behind the candles is very important. And again, I'm in the Forex community. A lot of them use like time frames, like 4-hour charts. I use that myself. It's very powerful. However, I really don't believe in a time frame of the market. I use 4-hour charts, hourly, 90-minute charts, etc., 5-minute, 15-minute charts. I believe in that. But I don't believe in using a time frame to validate my trade, because what does a 5-minute chart tell me about what's going on with buyers and sellers? Wicks form, resistance, like I mentioned earlier, how support and resistance forms. That forms because of the order flow. The order flow left a footprint, and the footprint is the impression the market makes, and that footprint gets represented by the candlesticks. So usually why wicks form is responsive participants entering the market, and how continuation forms, large drops or large rallies, is initiative participants entering the market. And again, reading the order flow, for me personally, gives that edge. There's no time frame of order flow. Order flow is simply a component of the now. And I think not only technically, but emotionally, let's dive into the power of the now, because this is a very important aspect that completely changed not only my life, but also how I trade. So let's talk about technically first. The power of now and understanding the market will give you everything you need to know in the current present moment. What it's telling you right now will give you the information you need to put a trade on, or it will give you the information to tell you not to put a trade on. So for me personally, waiting for like confirmation on a 15-minute chart or waiting for confirmation on a 5-minute chart doesn't give me information on the now. If the market just rejected a supply level and we start selling off and I wait for a 5-minute candle to close, for me, waiting for a time frame to confirm that setup might get me in way too late. But if I use the order flow and I use the power of the now and read the orders coming in right now, I can get in. I'm not going to say before that move, but as the move is happening. And that's where a lot of the edge will come in, is getting in. If you're in a position and you're longing the market, you want it to go up and you're buying it, you want to make sure other people are buying after you. But with order flow, you can put yourself in the position to get in as soon as you see the buying occur in the now. And if you use a candlestick chart, it might be too late. And if it's too late, it's going to skew your risk to reward, and it's going to put you in the position to be correct more often than you lose. Now, the second aspect to this is the power of now emotionally. A lot of traders can solve 95% of their psychological problems if they focus on the now. If they remove their focus of the past, past mistakes that they made, past trades they took, past emotional barriers that they had to overcome, they forget about that. It's the past. It occurred. You don't want it back. If they ignore the future, meaning you cannot predict the outcome of the market. You don't know what it's going to do next. You don't want it. You don't even want to know what it does next, right? That's the future. It's non-existent. It's unknown. We can't get that aspect. All we have is now. If you put your attention to the now and you put your attention to your emotions and you watch yourself think and you put yourself in that position right now, forgetting the past and not worrying about the future, 95% of your emotional problems will be solved in simple terms.
No, it's true, because most people either live in the past or they're fearful of the future. Versus, as you say, like the way I see it is that the past brought you to where you are now. And then what you do now takes you to the future.
Exactly.
So like being, sort of reflective on the past doesn't serve you in any way. No. And then worrying about the future doesn't serve you in any way, because it's all happening now as well.
Happening
so
now,
I love that. And we're kind of coming towards the end of the podcast. What I like to do is like quick fire questions. So I wanted to ask you actually, after going through your journey and obviously being where you are today, what would your thoughts in terms of the statement of trading being easy? Would you say trading is easy?
Trading is not easy. Trading is a performance-based skill. And anything that has to do with a high power or a high attribute or high success, you have to perform very high. And for you to perform very high, it's not going to be very easy. You have to go through certain aspects that a lot of failing people are not willing to sacrifice or go through. So no, trading is not easy. It gets easier, but it's not easy, because not only do you have to perform well, you also have to control your emotions.
And what would be your top 3 tips to traders out there where, let's say they're in the position where they've not got that consistency yet? What would be your top 3 things for them to get that consistency?
Start small. You have to prove the concept of your one pizza store working out before you can open up your second store. The first store is not working. You don't have a proof of concept, and your trading business is not working out. Don't scale up. So start small until you can prove consistency. Once you can scale up, now it's about repeatability. Can you repeat your process daily? If you can repeat that over and over and adapt to different market conditions and you're creative with it, that will propel you forward. And then most important aspect to it is you're not always going to be correct. So put yourself in the position to win-win, meaning when you are wrong, your losses are accepted, that you can view it as a win. Not only a win that you protected your loss, but it's a win because you took that loss and learned something from that loss. So if you put yourself in the position to win-win in the market, you're putting yourself in the position to grow your account and have a lot of success.
I love it. I'm sure we could have done this for even longer. We'll have to do a part 2 sometime as well.
We got to do it again.
Definitely. Well, everyone, thank you for tuning in. Make sure you drop a comment with your biggest lesson and takeaway from this episode. The links for Carmine will be in the description below, so make sure you check it out. He's got some incredible content out there as well. And as always, make sure you hit subscribe. And until next time, everyone, take care.